Hello everyone, today we're going to solve exercise 6.13, note transactions and unrealistic interest rates. On July 1st, 2025, Rental made two sales. It sold land having a fair value of 900,000 in exchange for 4-year zero interest bearing promissory note in the face amount of 1,416,163. The land is carried on Rental's books at a cost of 590,000 euros. It renders services in exchange for 3% 8-year promissory note having a face value of 400 euros, interest payable annually. Rental recently had to pay 8% interest for money that borrowed from British National Bank. The customer in these two transactions have credited ratings that require them to borrow money at 12% interest. Now in instructions. Record two journal entries that should be recorded by Rental plc for the sales transactions above that took place on July 1st, 2025. First, the key concept here is that when a note states that the interest rate is zero or very low, it doesn't reflect the true economic value of transaction. The note is really a combination of sale and the financing agreement. We need to find the present value of the future cash flows using the customer's market interest rate, 12%. In this case, this present value becomes the sales price, and the difference between this present value and the note's face value is an earned interest that will recognize as interest revenue over the note's life. So firstly, we need to identify the key information. Face value of the note. Carrying cost of rent. And fair value. Now, firstly, we find present value. So I accidentally typed the wrong number. I'm going to fix it now. Now we're going to prepare journal entries for July 1st, 2025. The present value is almost exactly like fair value of the land, so the sales price is 899,997.19. So we're writing here in journal entry DR notes receivable. Notes receivable equals 1,416,263. Here we write credit Here we write the discount amount receivable, and we find the discount by subtracting face value from the present value. Now we write the rank because it's in credit. Now we write the gain on disposal. We calculate gain on disposal by subtracting fair value from the cost. So it's basically gain on disposal 900 minus cost. Here we have the first step done. So now we're doing the second part. Second part is transaction. First, we need to identify the key information again. Face value of note, interest rate that is stated, sorry, in the text. %, no cash interest. We find it by multiplying face value of note to stated interest rate. Term 8 years. Market interest rate 12%. First, we calculate the principal present value of principal. So this note has two cash flow streams: the annual interest payments, an annuity, and the principal payment of maturity, a single sum. And we need to find the present value of both. Now we find present value of annuity. I'm going to change annual cash interest because for some reason it now shows percentage when it's supposed to show the numbers. Future value is 0. Here. Here we have the present value of principal and present value of annuity. Now we're going to find total present value. Here we have our total present value, And now we're going to prepare the journal entry for July 1st, 2025. Here we debit notes receivable for its face value and credit revenue for the present value. The difference is again a discount. Okay, so here, July 1st, 2015, debit notes receivable and its face value of 400,000, credit discount on notes receivable. We're going to find discount by subtracting face value from the present value. So it's this minus total present value. And here we have service revenue. It equals this, our total present value. All this to record service rendered in exchange for an 8-year 3% note. Thank you for watching. That's it. Now we're going to solve problem 6.8, notes receivable journal entries. On December 31st, 2025, Regent PLC rendered services to Beijing Group at an agreed price of 102,049, accepting 40,000 euros down and agreeing to accept the balance in 4 equal installments of 20,000 receivable for each December 31st. An assumed interest rate of 11% is imputed. Instructions: prepare the entries that will be recorded by Regent plc for the sale and for the receipts and interest on the following dates. Assume that the effective interest method is used for amortization purposes: A. December 31st, 2025, B. December 31st, 2026, C. December 31st, 2027, D. December 31st, 2028, E. December 31st, 2029. So now, here the interest rate is already imputed for us at 11%. We will use the effective interest method to recognize interest revenue. This method applies the market interest rate 11% to the carrying amount of the note at the beginning of each period. This is here an amortization schedule in Excel. It's incredibly helpful. So this is where an amortization schedule in Excel is incredibly helpful. First, we need to write the key elements, key information, to be exact. So the service price is 102 or 49. Down payment 40,000. Balance to be paid in notes equals equals 102,049 subtract 40,000 equals 62,000 of all 49. This 62,049 is the present value of four future installments of 20,000 at 11%. Now we're going to create an amortization schedule in Excel. So it's like the heart of our problem. First, we're going to set up our columns. Here I'm going to type year. Then I'm going to type interest revenue. After that, I'm going to type principal reduction Sorry, I'm supposed to type before this. Ё-моё. Cash received. Principal reduction. Carrying amount. First year 2025, 2026, 2027, 2028, 2029, and that's it. So here we're going to write our carrying amount of the amount of 62,049. Cash received is going to be 20,000 for all 1, 2, 3, 5 columns. Well, except 25, of course. 20,000. And to find interest revenue, we in 2026 we take the carrying amount and multiply it by 11%. So to find principal reduction, we deduct 6,825.39 from 20,000. And to find carrying amount, we deduct from 62,049 our principal reduction. Here we have it. Now we do the same things with the whole table. Here I'm editing a little bit of the table so it will be easier to use. So now we're doing the, I definitely need to cut this part. Okay, so now we do the same thing with the rest of the table. We take the carrying amount multiplied by 11%. $20,000 minus 5,000. Here we have a principal reduction. Carrying amount minus principal reduction, 32,000. I could do it by dragging all of this table down, but unfortunately I have iPad and it's quite hard for me to do that. So I'm doing it all manually. We almost have a zero, so I'm going to assume it's going to be a zero. And the final interest revenue is rounded to zero to ensure the carrying amount goes to zero. Now we're going to prepare the journal entries. Okay, so here goes our date. It's December 31st, 2025. Here comes our debit account. Okay, it's cash equals 40,000. Here are notes receivable equals 62,049. And here comes our credit account for the saving. So basically it's both notes receivable plus cash. Here we have our journal entry for date December 31st, 2025. Now we're doing December 31st, 2026. Here we write in cash, amounted 20,000. And now we have notes receivable and interest revenue in the credit. This is our way to record first installment and interest revenue. Now we're recording December 31st, 2027. Here comes our debit. Cash, 20,000. Here comes our credit. Notes receivable and interest revenue. This is our second installment and interest revenue. Now we're going to write December 31st, 2028. Debit, cash. Okay, we didn't write cash for some reason. 20,000. Credit, notes receivable, amounted 60,232. And okay, interest. Here we have our third installment. Now the last one. December 31st, 2029. Here comes debit. Cash 20,000. Credit not receivable. And our interest revenue is 9,981. And that's it. By using Excel's PV function and building a simple amortization schedule, we can accurately account for complex notes receivable transactions. The key is always to use the market interest rate to find the true value of transaction. I hope this tutorial was helpful. If you have any questions, please leave them in the comments below. Thanks for watching.